I'm Andy Stockett with FourBridges Capital Advisors. Today, we're pleased to have Kathryn Thompson, the founding partner and CEO of Thompson Research Group in Nashville with us. Good morning, Kathryn.
Good morning. Great to be here.
Great. Thompson Research Group is a research and consulting firm providing equity coverage of the construction and industrials industry for a wide variety of mutual funds, hedge funds, pension funds, and other institutional investors.
Thompson Research Group is an equity research and advisory firm focused on the construction industrial value chain. So the way we think about it, it's old world. Anything that touches res, non-res, or public construction. It could be a product, it could be a service, it could be around policy, it can have a very consumer bent. We care about that. Two sides of our business, our equity research side, we provide buy-sell public equity recommendations to hedge funds, mutual funds, and pension funds. And our other side of our business, which is faster growing, consulting and advisory, we work with a wide range of companies, both public and private, venture capital, and some of the largest private equity funds in the world.
Also joining us today is Ralph Montgomery, my colleague at FourBridges Capital, who's completed a number of transactions, primarily sell-side transactions for business owners in that same construction and industrial services. Good morning, Ralph.
Good morning, Andy. Kathryn, thanks for joining us. Your expertise is, I think, well suited uniquely to our practice. We specialize in helping a lot of industrial companies, old world companies like yourself, specifically specialty contracting, building products, and the like. So interested in getting your thoughts on those industries. And so maybe just jump in with a few questions and then sort of let you run with it and
Sure.
give us your thoughts and insights. Certainly the types of businesses we work on are subject to economic swings and regional differences. It doesn't appear that things are the same all over the country, and just wanted to get your thoughts on what's driving that and some of your insights about those differences and where we're going.
Yeah, so it's you can't really talk about the cycle until you talk about COVID. So the other kind of C word that's out there. But the reality, if you step back and look at the forest for trees, there were some major secular fundamental changes in the world, in the US at least, that were already in works pre-COVID, and then COVID just put rocket fuel on that. And really what I'm talking about is population shift. And if you look back at American history, and keep in mind I come from a family of history professors, you can look back at times, there's really kind of two things that really drive major structural population shifts. There's an economic or financial driver followed by a social. So the trend of the last century, you had that. And for us, first, it was a Great Recession. And the Great Recession was an event where you ended up having headquarters and other major businesses starting to move to the Southeast and to the Southwest. So you think about Nissan North America, Toyota North America, moved from the West Coast, moved to Dallas and to Middle Tennessee. So that's a really good example specifically for that. Then you layer in the social side of it with COVID and the obvious upheaval that had on the market overall. That has really put rocket fuel on that population shift. So it wasn't just about more favorable labor laws and tax rates and things like that. Now it was exposed some structural weaknesses. So it's the ability to work year round, better quality of life, ability to be outside, for a longer period of time. And so when you look at when we talk about is what type of shift is this? I mean, we view it as a multi-decade type shift. And yes, you had some big moves in the wake of COVID, but I think it's just going to continue to trickle. And it'll end up having some unintended consequences, and not necessarily bad, but just from a business structure standpoint. Just putting this in a number, every state in the Midwest has a lower population ranking in 2020. So this is even before pandemic versus 100 years ago. In 1923, out of 10 Americans lived in the Northeast. Fast forward today, that's 2 out of 10. So you're just still, the numbers bear it out, but basically the bottom line, you have a growth to the Smile States.
Right. We focus mostly in the South, of course, and so a lot of our clients are specifically, feeling what's going on down here. And one client in particular doesn't know if they're ahead or behind the curve, because I don't feel like, or they don't feel like they're tracking the broader maybe commentary or market in total. But I think that goes to what you're saying, that that population shift, maybe the volume that they're seeing here in the Southeast is perhaps a little different than what they are in the Midwest or Northeast.
Yeah, and we see it in we're seeing it in examples now. So we talk to private companies just from a research standpoint, and we have this private fencing company manufacturer based kind of in the mid-Atlantic on the edges of the Northeast. And what's interesting, they have business from Maine down to the Carolinas. And when things started to get a little softer in the late spring and early summer, their business in the Carolinas was pretty steady. But things in the Northeast and the Mid-Atlantic had turned negative. So that's a really good example of every day of that. Right.
What you can't read a business article these days without reading or hearing the word inflation. What are you seeing or hearing these days as we're now in the back half of 22 and maybe we look towards 23?
Sure. Yeah. So inflation's been a funny thing, because when at the end of 22, TRG as a firm, we put out an annual piece of like things to pay attention to next year. And, inflation was like, inflation is going to be there. And there were a lot of economists that, patted us on our head and said, why don't you just go back to being analysts and talking to concrete companies and the like. But it has proven to be a big issue. But you're already seeing, some of it was anticipated. Like it's to be expected when you have this big of a jolt. Some commodities improve. Steel certainly has. Aluminum, you're already starting to see the ease in that. But there's some other industries that are structurally going to be a little bit harder. Those would be kind of value add type products, so think appliances and things like that. But then there's other industries that are a little trickier. Like the cement industry is a very good example. US production can't meet demand, so we've been an importer. And part of it is it's the hugely capital intensive business with lots of environmental regulations. Cement is the second largest emitter of CO2 globally. But cement plants across the US have been working so hard to meet demand. These are huge plants that require 24/7 operation. You can't just shut it down willy-nilly. There have been so many extended outages and just wacky things happening. Like there was a fire at a plant in Dallas-Fort Worth area. I've heard more fires and chronic breakdowns, but what it tells me is like you have some parts of the value chain that are working so hard right now, they're experiencing structural weaknesses. And then that ends up having a trickle effect down the line. So there are, I guess it's a long-winded way of saying inflation is certainly going to get better for many categories. But that doesn't mean that all categories are going to be out of the woods, which is a little bit different than how it's been in previous experiences in the US.
Right. So and related to that, I guess supply chain, maybe you can comment on that a little bit. Are we, is the worst sort of behind us, or where do you think we are with that?
Well, I think we're a little better. But we're dealing with the other I word, inventory issues. So it kind of depends, once again, it depends on where you are. There are some industries that have done a better job at managing the supply chain, including shortages, and hence have done a little bit better job of managing inventories. So if you think about a company like Ferguson, large plumbing distributor, largest plumbing distributor in the US. And they had to deal with the same thing with appliances as everybody else. But they also were very early in saying, okay, we don't want to get over our skis with inventory. They're doing a better job. Where the issue comes in are other, companies like a Target, which is over inventory, which is a boon for a company like WillScot. I was at Target just this weekend, and you have rows upon rows of WillScot Mobile Mini units holding excess inventory. So there's an excess, clearly, of some type of product, a shortage of others. I think it'll get better. The big question I think we had as Ukraine heated up to all of our company contacts of like, what are you going to do about this? Because it has unintended consequences for supply chain. A good example of that would be for porcelain and tile product built, manufactured in Italy and Turkey. And a major source of raw materials is from Ukraine. The industry ultimately did a pretty good job of navigating around it. And the industry in the US was able to find different alternative sources. But ultimately, it goes back to the COVID experience and the tariff experiences that have gotten people better at problem solving. So that's kind of a way of, another way of saying we've just gotten better at working around supply chains too.
Right. Maybe bringing it back a little bit to specifically, construction and building products, both residential and commercial. What are you seeing? Maybe again, we've got a couple clients in that sector right now, and they're all trying to figure out. I don't want to say they've hit the pause button, but maybe they've gotten a little bit more cautious in trying to figure out where we're going for the rest of this year and next. Any particular commentary on just construction, whether again residential or commercial?
Mm-hmm. Yeah, I'm going to start with the easy one, which is commercial. A lot of visibility. And even if there is one project that may be pausing, there's a dozen more in the backlog that will kind of give some visibility. And so where we get feedback from this are just a lot of companies. So in fact, we were out with Mohawk top management in New York meeting with institutional investors a little over a week ago. And they echoed feedback that we're getting from everything from concrete producers to drywall installers. So a fair amount of visibility on that end market. Where it gets dicey is on the residential side. On the one hand, a company like Mohawk say, RMI is the first place where we see weakness, and we're seeing it. We're starting to see softening. On the other hand, we're talking to contractors who are saying, rates have gone up. That consumer who thought that they were going to buy a home are staying put and tapping into the equity they have in their existing home to do that remodel instead of going out and buying. So I think it's a very mixed bag when it comes to RMI. Although I think on balance, people are just kind of waiting to see where everything shakes out. Which gets to new residential. I think kind of one of the number one things, it's not just that rates are going up, it's just the velocity and understanding where it's going to stabilize. And I think that more than anything, also coupled with inflation, when you were having major home builders putting pause on buying land or land purchases early in the summer and late spring, and part of it's just because they've seen this before and they want to get a better sense of cost, and I think they can get a better price later this year, early next year than now. But that's gonna, really, once again, going to the Mohawk, they're fine right now, but they're waiting for the shoe to drop. But there's others that have clearly seen a little bit slower pace. And I guess my final point with that is, this is a large, when I say a large, it's about a little $1 billion+ building product distributor. Has business all across the US. And they gave a really specific example in Florida, and not in kind of like your vacation land, but just like parts of Florida where you and I would, work and live along that lines. They said, listen, we have a project where they need 200 trusses, and we absolutely can't meet that demand. In fact, 160 is our absolute max. That's all we can do now. So the demand goes from 200 to 160. We're still busy.
Mhm.
And so that's a little bit of the market of where we are now. And I think, once again, going to Smile States, it's probably going to be how we're going to be for the rest of the year.
Right. A little curveball for you, so forgive me. How is labor impacting that? Any commentary? I know we've been scratching our head trying to figure out, exactly what's going on with labor, broadly speaking, across many industries. I didn't know if there was any commentary to how tightness in the labor market is affecting some of what you're seeing in the construction industry.
Yeah, well, the construction industry isn't alone. I'd say it's broadly services. I think there's been an underestimation of the existential impact of COVID. And that's a little soft, and people, in our world, are a little cautious to kind of get to that. But I wouldn't blame generation fill in the blank are just lazy and they don't want to work, or these people have drug issues and then they just don't want to work. I think it's a little bit more. It's getting down to the why behind it. Candidly, when it gets down to job security and not the possibility of not having a job or not being able to get a job, I think we'll send people back to work. I'm part of this, I have a lot of connections with some of the financial centers, New York, Boston. I'm part of this macro group where we do this weekly call, and it's a bunch of really smart guys in macro, and then I'm the fundamental person. And they're all in New York, kind of New York, Boston area. And so my theory that I put out was look at the parking lots for the train stations that are commuters that are in Connecticut and Jersey. And sure enough, those guys started sending me pictures. And I'd say about 3 weeks ago, I got a picture of a full parking lot on a Friday on a commuter train. And that's, to me, that's really telling. It's like when people are going back to the office because they're concerned about job security. I think as far as the labor shortage, I think a little bit of it now, people are having a hard time coming back, but also they can get a job. But when you have a little bit of scarcity, that's when it makes it a little bit different.
Right. I appreciate that. Well, our world, of course, is M&A, and we spent the last couple of years, being pretty busy around here, and we were fortunate. I think everybody was, of course. Again, on some of our clients, we've been out with recently. We've seen maybe a little bit of cautiousness on behalf of buyers. They were very robust, good liquidity over the last couple of years. So just any commentary you have on M&A market in general, kind of where we are, where we're going, and maybe related public markets? Yeah.
So private investors or private companies so often say, I'm so glad I'm not public. I get to rule my own roost, and I'm completely not at all impacted by public equity markets. When in reality, that's absolutely not the case. If you're a company and you have if you're doing business in the US, you're going to be impacted by the public equity markets, even though there's fewer stocks traded and everything along that, because it impacts sentiment ultimately. So if the market's down every day, essentially, in a more simplistic way of saying, every day mark to market, publicly traded stocks are determined what their future cash flows are and the optimism for their future cash flows. So it's a daily snapshot of where the world thinks everything is. Yes, there's some differences. Some companies do better than others in industries, but that's it. So that definitely is going to impact that. Once again, going back to interest rates and just getting some line of sight of visibility, And, uncertainty kills the market. So today, the market's bloody because of devaluation in China of currency. And so overall, like, well, where are we with deals today? Kind of getting to the point. I tend to think that we're going to, as the year comes on, you'll have some, major noise around, barring some complete unforeseen event. I think the markets will get better. And I think actually by the start of next year, you're going to have a pretty robust market. There's companies that were thinking about doing the IPO process that are going to gear up and get that going next year. So really now it's just about the uncertainty, but I think we're getting a little bit closer to having a better understanding of where we are. And some of the fears people are learning are maybe perhaps not as big and bad as scary as they thought.
Right. Are you seeing though with some of the, again, we saw robust activity from the private equity market and the strategics. Are you seeing some of those larger strategics that you might be talking to, have they pulled back at all on, in terms of M&A, some of the add-on acquisitions they might have been making in the last couple of years? Have they slowed down or paused a little bit until they see how this year pans out?
I think what we're starting to see is people that paused are moving forward with pruning activity to kind of get ready for others. So a good example of that is today, actually, talk about Will Scott Mobile Mini, ticker symbol is WSC. They had pretty publicly talked about pruning for a portion of their portfolio, and they made an announcement today, pretty big transaction, sale of around $300 million. That was part of that pruning process. That's a good example of one. Martin Marietta Materials made a huge acquisition out west, heavy materials, but there were certain portions of the assets that we knew were going to be pruned. Well, they wrapped that up a few days ago. So, but in any case, you're starting to see that, which is the precursor to bigger things. And my final point, I say, once again, this is just like a good, it foreshadows, I think it's very interesting, I'd say, for public equity investors and for private equity investors. They're looking for new ideas. And I'll give you a specific example, one I can talk about. Once again, I talked about Mohawk going the road. Mohawk's a name, it's an $11 billion market cap company. It's a company that if you are an industrial portfolio manager for a hedge fund or mutual fund, Mohawk is old hat. And so you go to these events where you have one-on-one meetings, but you do a group lunch for current shareholders and prospective shareholders. And for a company like Mohawk, everyone knows the company. Everyone knows it. But for our group lunch, the majority of the people that were attending didn't know much about Mohawk. And I'm sitting around looking at them. It's like, you've got a major fund out of London, a very well-known hedge fund, been around for 30 years in New York. You have all these people, and when it got down to it, they weren't looking for a free steak lunch. They were looking for a new idea, and they were open to it. So I think that to me is like a really interesting. Like I had not experienced something like that in 15 plus years. And actually, it might even be longer than that. I don't want to date myself too much, but it's been a long time. And on the private equity side, people are starting to think, and they're more open to pulling the string on creative ideas as opposed to like, hey, we got 30 minutes. Let's get caught up in X, Y, and Z.
Right. That's great. We like hearing about companies in our backyard, of course, that are getting more attention, I suppose. Mohawk's drawing a crowd. That's a good thing.
Yeah.
So, Well, listen, we're kind of bumping up against our time, I think. So I don't know, Andy, if you have any other questions you want to throw in here or not. But Kathryn, I appreciate your time. This has been very helpful for us. So hopefully we can do it again soon. But very much appreciate it.
Thank you for inviting me.
Yeah. Well, thank you both for joining us today, and we'll look forward to maybe a catch up in a couple quarters and see how things have panned out, Kathryn.
All right. Sounds good.
Thank you.
Thank you.